Our next lecture is the break-even analysis. Break-even analysis is a managerial accounting technique that helps to estimate the relationship between sales volume and production costs. It helps to determine how the change in sales will affect the operating profit of a business. The key performance indicator is break-even point that represents such production and sales volume in which revenues of a business are equal to the sum of total variable cost and total fixed costs. At that point, the total contribution margin is also equal to total fixed costs and the operating profit of a business equals zero. There are some basic assumptions of break-even analysis, such as 1. Total fixed costs remain constant at all output levels. 2. All the costs can be considered as either fixed or variable costs. 3. Straight line cost and revenue behavior. 4. Throughout the output level, sales per unit is constant. 5. The business has a constant product mix and produces only one kind of product. 6. The inventory remains constant at the start and at the end of the accounting period. 7. Costs and sales revenue is affected only by the sales volume. 8. The unit variable cost remains constant since the change in total variable cost is considered to be proportionate to the output level. 9. The other factors such as efficiency, production, and technology do not change. Components of break-even analysis. Break-even analysis is done by establishing a relationship between three significant elements of a project, that is, costs, revenue, and contribution margin. Computation of break-even point. Break-even point is that point of sales where the company can meet the project's cost from the revenue generated by that particular project. The formula for calculating break-even point in units is BEP equals FC divided by P minus VC, where FC equals fixed costs, P is selling price per unit, VC is variable cost per unit. It can also be interpreted as fixed costs divided by contribution per unit, since contribution per unit is selling price minus variable cost per unit. Break-even point in sales is calculated by multiplying the break-even point in units by selling price, or using another formula, which is BEP in sales equals FC divided by S minus TVC times S, where S is total sales, TVC is total variable costs, FC is fixed costs. Graphically, the BEP lies in the intersection of the total cost and total sales curves. Example: a company sells 12,000 units of a single product at $100 per unit. The variable cost is $70 per unit and the total fixed cost is $270,000. Calculate 1. The number of units to break even. 2. The sales at break even point. So solution: the number of units to break even is BEP in unit equals fixed cost over selling price minus variable cost per unit. That gives us 9,000 units. The sales at break-even point is BEP in sales, which is fixed cost divided by selling price divided by sales minus TVC, which is total variable cost, all multiplied by total sales, and that gives us $900,000.